Howdy, we are moving on to part 4 of chapter 6. And here we're going to start off by discussing incentives to diversify. So one reason to diversify is because of antitrust legislation. So antitrust laws in the 60s and 70s discouraged mergers that created increased market power through either vertical or horizontal integration. Mergers in the 60s and 70s, as a result, tended to be unrelated. But when you have relaxation of antitrust enforcement, you get more and larger horizontal mergers that can create market power. We see a lot of companies do this, such as airlines, for example. In early 2000s, antitrust concerns seem to be emerging and mergers are more closely scrutinized. So we'll kind of see this go up and down. Another thing to consider here is tax laws. So high tax rates on dividends cause a corporate shift from dividends to buying and building companies in high performance industries. If your investors are going to lose so much money in taxes if you give dividends, it may be more beneficial for them, for the company, to look for any new investment opportunity. The 1986 Tax Reform Act reduced individual ordinary income tax from 50 to 28%. It treated capital gains as ordinary income. It created an incentive for shareholders to prefer dividends to acquisition investments. But this will also change when dividends and the tax on dividends changes. Another internal, so those previous were external incentives to diversify. An internal incentive is low performance. So high performance eliminates the need for greater diversification. The company's doing well and performing high with perhaps a dominant or even single business. Low performance acts as an incentive for diversification. Firms plagued by poor performance often take higher risk because diversification is risky, particularly when you see firms that maybe they're even nearing bankruptcy. They're going to try new things and do whatever it takes to try and succeed before they go under. So there's a curvilinear relationship where if you have a dominant business or a business that has a low level of diversification, it can perform well. But if it's able to achieve some level of economies of scope, perhaps through a related constrained level of diversification, it can actually become more profitable or have higher performance. But if the company becomes too unrelated, in many cases, the firm will become inefficient and not perform well. So there can be an optimal level of diversification for any organization, and each organization needs to figure out what that would be. Another internal incentive to diversify is uncertain future cash flows. So consider if a product line were to mature, a product line may be threatened. Consider if a patent were running out and you are not going to be able to continue making money in the same way on a product that you're selling. Also, if a firm is small or in a mature or maturing industry, it may be time to start looking for new sources of revenue, new opportunities, and diversification may be the reason or maybe the path to do that. There's also synergy and firm risk reduction. So synergy exists when the value created by businesses working together exceeds the value created by them working independently. However, synergy can create joint interdependence between business units. A firm may become risk averse and constrain its level of activity sharing. A firm may also reduce its level of technological change by operating in more certain environments. Depending on what's going on, there may be reasons to be more or less diversified based on risk and based on what the firm is experiencing. So a firm must have both incentives to diversify and also the resources to do so, particularly the resources necessary to create value. This may be both cash and tangible resources. Value creation is determined more by appropriate use of resources than by the incentives to diversify. Strategic competitiveness is improved when the level of diversification is appropriate for the level of available resources. So question number 4, what personal motives do CEOs have to diversify their companies?